The S&P 500 is currently down nearly 10% to start out 2022, and many are saying that this could be the start to the next big crash or even an economic recession. In this video, we are going to talk about why news articles like this can be destructive to your returns and what we are personally doing in light of these negative headlines. Now, I want to start off by talking a little bit about fear and emotions. When fear enters the market in such a pervasive and provocative way, it definitely makes Chris and I reflect on our investments and our strategy. And more importantly, it makes us think about what we should be doing to keep our emotions in check. And if you've been on our channel before, you know that we often talk about how emotions are a killer to investment returns. Emotions quite often drive us to do exactly the opposite of what is prudent. A really great example that highlights the potentially destructive influence of emotions in investing is the case study of the CGM Focus Fund. So there's this article called How to Lose Money in the Top Performing Fund by a guy called Bob Vayers, and it was originally published in the Wall Street Journal in December of 2010. Okay, so in the article, Vayers explains that the CGM Focus Fund was the top performing mutual fund by far between 2000 and 2010. The fund earned an annualized return of more than 18% for the 10-year period. But the crazy thing is that the average investor in this fund actually lost 11% a year during that same 10-year period. And this is because investors were piling into the fund following years when the fund was performing super well, and it was a race to the doors after the bad years. The average investor hit the big waves down, and unfortunately, they did not partake in the big waves up. And this isn't a one-off situation either. Legendary investor Peter Lynch, who formerly managed the Fidelity Magellan Fund from 1977 to 1990, averaged an annual return of 29%. But according to Fidelity Investments, the average investor in the fund actually lost money during Lynch's time managing it. So how are we staying calm? Well, first of all, a lot of our perspective comes from who and what we choose to listen to. Most of the people who we consider to be the best investors of the world are contrarians in nature, and they act against the crowd, and they've made fortunes from doing it. We often think of Warren Buffett, who says, "Be fearful when others are greedy, and greedy when others are fearful." Or Nathan Rothschild of the Rothschild banking family, who said, "The time to buy is when there is blood in the streets." And you can see this in practice when you look at the performance of funds of great value investors like Warren Buffett, Charlie Munger, Walter Klaas, Monish Pabrai, Guy Spier, and Phil Town. The second thing that keeps us calm is our strategy. So we are primarily long-term value investors buying businesses that we believe, based on their fundamental characteristics, will be worth far more in the future than what the market is pricing them at today. And Warren Buffett has said, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. And we are taking that advice to heart. So we're actively looking to buy businesses that we understand, have strong, durable competitive advantages, have capable management, and are priced at a discount to their intrinsic value. And we determine intrinsic value as the sum of all their future cash flows discounted back to today's price by an acceptable rate of return. And if you want to learn more and see how we do our valuation step by step, I'll link some of our recent videos in the description for you to check out. The last thing I want to talk about in this video is what we are personally doing right now with all the shit that is going on in the world that may have huge impacts on the market. It boils down to three main practical activities. First and foremost, we are ready and waiting for opportunities to buy wonderful businesses at discounted prices. We're building an updated watch list of companies that we really want to own, doing the intrinsic valuations, and setting strike prices at a discount to that value. This way, if market conditions bring the stock prices down on these companies, we will be ready to buy. Over the coming weeks, we're going to do a big series where we will share our watch list and give you a quick overview of why we chose those companies. And then we're going to do standalone valuation videos for each company on our watch list. So if you want to see that, be sure to subscribe. Secondly, we are continuing to allocate a small percentage of our portfolio to index investing. At the start of each month, we buy the VOO. And the VOO is an index ETF that tracks the S&P 500 and has a low maintenance fee. A really important part of our strategy is that we use cost averaging, which mitigates our risk and enables us to take advantage of lower prices if the underlying index drops. If you want to learn more about this, I did a video recently that details the whole process and shows you all of the trades and how our portfolio has done to date, and I'll also link that in the description. And finally, we regularly use options to enter and exit positions. Again, we have a pretty specific strategy for using options. Basically, we only sell put options on stocks that we want to take a long-term investment in. And to further mitigate our risk, we usually set our strike prices at 5 to 10% out of the money. And on top of this, the premiums we collect further reduce our cost basis. We haven't really done a good video for this yet, so if you want us to show you exactly what we do, let me know in the comments and we'll add it to the lineup. Now remember guys, I am not a financial advisor and I am definitely not your financial advisor, so you should not take this video as financial advice. Alright guys, that's it for me today. Thank you so much for watching. I hope you found the video useful. Remember, earn more, spend less, and invest the rest, and I'll see you next time.